All right, we are on. What's up, everyone? How you guys doing?
Hey, good morning.
All right, so to our audience, my name is Neil Henning. I'm a real estate investor. I specialize in multifamily, small multifamily, 2 to 4 doors in the Montgomery County and Delaware County areas. And really, we are looking to provide you with some content during this time. We know it's a tough time out there with COVID-19 and everyone locked down, and anyone that thought about investing may find some obstacles. So we're here to slow it down, give you some tactical things, strategies, things that you can actually do, and steps you can put in place now to really build the foundations of your business and to make sure that you hit the ground running, if that's what it is, or if you already have a property or a couple properties, you can get your next couple easier. So that's what we're here to do. And I'm going to pass it off to our counterparts over here.
Nice. I'm Matt Porter. I work with Will at William Holder Realty, operations manager, and run a lot of the marketing campaigns and do a lot of the website things. I'm a pretty new investor. I've only completed one deal only recently. So I'm still really new to this entire endeavor, and I'm just trying to push any sort of learning I get along my beginning stages to other investors who might be starting out as well.
Great. And I'm William Holder from William Holder Realty. Most people call me Will. I'm a real estate agent as well as a real estate investor. I've done 5 real estate investment transactions, a couple burrs, a few flips, and so on. I am the team lead for William Holder Realty, and I've partnered with Matt Porter through Precision and Accuracy Properties to complete our most recent burr, and I've worked with Neil and Dan from Highview Homes as their real estate agent, and hopefully get to partner with them on a few deals in the future. So I hope everyone's doing great, and looking forward to giving you as much information as we can throughout the series.
Cool.
Thank you.
All right,
Yes.
Will, you want to start us off and kind of run us through some of the different strategies that you could take. Let's take a in the beginning of your real estate investing, when you want to begin, you want to jump into it. How should someone start their real estate investing?
Yeah, I think we wanted to kind of start off the series we're going to be doing with talking to people about choosing a specific geographic location to invest in. One thing we hear over and over and over again from experienced investors that have been doing this for decades is that if you can master a location, you can rinse and repeat consistently and scale your business. So especially if you're a new investor, it's really important to find a specific location geographically that works for you. And there's a lot of different models to look at to come about how you're going to choose that geographic location. I think the first one that most people kind of work by is the cash flow model. Picking a location that that cash flows consistently and significantly. A lot of burr investors, which is burr is buy, rehab, rent, refinance, and repeat, is a great model. But if you're going by that model, generally you're not cash flowing significantly. Most investors are happy making $100 or $200 a month after all of their when the transaction's completed, all of their bills are paid. Their expenditures are paid. They put away for capex and vacancy and property management. You're seeing people not making a whole lot of money that way. There are markets that you can make a lot of cash flow per property per month, $300, $400, $500, $600 per month per door. That is possible in some of these cash flow areas. So Neil, did you have any comments about the cash flow model and your thoughts on it?
Yeah, definitely. I mean, that's my main strategy, is to find properties that cash flow. That doesn't mean that I don't care about appreciation, because I think that it would be silly not to look at that as well. But it's not my number one concern, right? So for instance, especially in different areas of the country, I know like California is heavy in an appreciation model, but not as much as the cash flow model, right? So around here, generally you'll kind of see the opposite, especially through the appreciation over the last, what, I don't know, 5, 6, 7, 8 years, whatever it's been, has been tremendous, right? Especially in the Philadelphia market. So for me, I care about cash flow. I don't need a lot of cash flow. My number is $200 per door. So I look to make, after everything, $200 per door, because look, I'm not getting rich off that, right? But at the same time, I know someone's paying down my mortgage, right? So that for one, I'm getting $200 a door. So the more doors I add, the more money that goes in my pocket. I have tax savings, right, on the back end. So I get taxed easier than traditionally I would with my 9-to-5 job. So there's a lot of benefits in there for me that I still believe in. So that's my standpoint.
Yeah, I think the cash flow model would work for most people in that if you're outside of a major metropolitan city that's currently blowing up, Philadelphia is a market that, we're outside of the Philadelphia, really near to the Philadelphia, but right outside of the Philadelphia region. That's a market that's blowing up in terms of appreciation because people can't afford New York. They're moving south. There's a ton of reasons for why geographically Philadelphia is a great appreciation market. But if you start to get outside of the city and you're in a county, which is most of the country, you can easily pick what neighborhoods are going to be strong for cash flow. Where you can get cheaper houses, where you can get solid rents, even if they're Section 8 rents. Mm-hmm. And that's where most people fit in, I think, is that you can find those neighborhoods, just growing up in your county, what those neighborhoods are that are higher rent population neighborhoods, and you can get cheaper properties and still get good rents. So I think the cash flow model is talking to the majority of people that are either getting into investing or are investing.
Yeah. In fact, you mentioned Section 8 real quick, and geez, like a lot of people hate on Section 8, but don't you know they're the ones getting paid right now consistently.
Exactly.
So,
Yep.
We just finished up a property, as you sold it, helped to purchase it, and we're having trouble finding someone because it's a tough market, and I was just thinking the other day, like, we need to pull this and go Section 8 with it, because it's although we won't get, our rents won't be as much, it'll be guaranteed, or pretty close guaranteed, as long as we do our part, right? So there's nothing wrong with that. You still get great tenants in there. There's big misconception that the tenants are terrible. That's not true. In fact, they have guidelines they have to upkeep your property with. So yeah, I don't have any Section 8 properties now, but I'm definitely not opposed to it. And in fact, I might turn this last one into it. So
yeah, I mean, those are, that's guaranteed rent right now. With what's going on with COVID-19, on tenants. I mean, one of my tenants is a waitress. She's been laid off, and luckily she got unemployment. But a lot of people aren't in that situation where they are still waiting to find a source of income during this trying time. And if you're Section 8, you don't have to worry about that. Yep. So that's a big benefit to some of these cash flow areas. The other upsides are you can find properties for fairly cheap. I mean, if you're a newer investor and you don't have a ton of money to put down, it's not the worst place to start. It's a good place to start. You can get decent rents, especially if you go Section 8. I know a lot of landlords that get similar rents for non-Section 8 properties versus landlords that have Section 8 properties, and they paid much more money for those properties, sometimes 2-3 times as much, and the rents are similar. If you're starting with a smaller deal, a cheaper deal, you could kind of grow your portfolio quicker because you have less in the transaction. So there's that. And, as you said, the Section 8 is big. The downside to some of these lower areas, is that you are dealing with a lower grade tenant, and there are difficulties that come along with that. Some more issues come up with the tenant. You probably would definitely want a property manager if you're not familiar with the area or if you're not local to the area, because you're going to be spending a lot more time managing this tenant. So you have to factor for a property manager in your understanding of how you're breaking down the income from that property. Lower income areas tend to dip more heavily in economic downturns. So these are the markets that get hit the hardest in harder times. This isn't, again, we don't see COVID-19 as a real estate crisis. It's a health crisis. But in 2008, when there was an actual real estate crisis, those were the markets that got hammered. And unfortunately, there were a ton of foreclosures. If you're a landlord that owns a property there, you're going to lose value in times like that. And that's why it's a cash flow model, not an appreciation model. But your rent should still stay strong. And
quickly on that note, there will be many foreclosures to come. I saw the number the other day of forbearances that are going on in the United States. It's insane. It's I'm blanking on. I think it was over 4 million so far have went through. 4 million people file for forbearances. That's crazy. And what I think a lot of people don't know is that in 3 months, I think it's a 3-month forbearance, right? In 3 months, like they owe now 4 months worth, right, of mortgages. Just I foresee a lot of foreclosures to come, so could be some take advantage of these areas and go after.
As a person that's been asked this question a lot of times by my general clients, if you can avoid this forbearance, avoid it. It's not in your best interest. If your bank is allowing you to tack the payments onto the back of the mortgage, great. That's fine. It's okay. But if they're saying that in 3 months you're going to owe 3 full months payment then and there, it's unlikely they're going to be able to make that payment if you can't make 1 month's payment now. And we don't know how long the quarantine is going to go on. We don't know how long work stoppage is going to be in place. Don't put yourself in that position. So hopefully there are other options for you. Hopefully that's your last resort, but I wouldn't recommend doing it. So
I've got a question. So like, I know a lot of the stock markets have like plummeted and are on their way back up right now. If that continues or not, we don't know. But as an investor, let's say I've never invested before, and I see this, I'm halfway intelligent, and I see that this is an opportunity with the market slowing down. Does the real estate market reflect this sort of drop in prices and potential like entry point? So basically, is this a good point for a first-time investor to get into the real estate investing? Just like it is a good point right now for a first-time stock market investor to get into the stock market, because it seems like those two would go hand in hand, but I'm not sure.
Well, the most I can tell you about the stock market is buy low, sell high, right?
Right.
Warren Buffett, listen.
right. So if you're this seems to be a great time for people trying to get into the stock market that couldn't get in previously because things were tough. In terms of the real estate side, things were becoming extremely difficult to be a real estate investor, especially in our region because of how much it was appreciating. So I would say that it's going to get easier. I don't know if it's right at this moment. I don't think it is. I think it, as Neil said, 3 months down the line, when you see these forbearances start to really happen and go into play, and then foreclosures start to happen, that's when it's going to make it easier for real estate investors to get into the market, when there are more vacant and bank-owned properties on the market for them to bid on.
So let's say that I have like limited amount of money, and I know that I want to be investing, but I'm not sure how to position myself, but I see this as an opportunity. How can I best like prepare myself for 3 or 4 months from now when it seems like these forbearances might be turning into foreclosures, et cetera, et cetera?
I think the best place to start right now is kind of going about what we're talking about, starting by choosing your location, making sure your credit's right, getting your savings up, putting yourself, if you haven't created an LLC yet, create an LLC, talk to realtors, other investors, contractors, put your plan in place. And that's kind of what a big part of the series is putting a plan into place to really kill it once the market is where we want it to be as an investor. Would you agree, Neil?
Yeah, I'll tell you, I'll hit both of them real quick. Simply put, would I recommend a new investor to look to purchase a property currently, right now? Simply put, no. I don't think it's the right time. I think there can be an opportunity for someone to purchase a property, right? And I'm not saying you have to be like really seasoned or anything like that. Like I'm still looking to buy currently, but I'm just being very selective about it. But and even that's a lot harder to do. But I'll tell you right now, no, it's just not a great time. Prices have not come down as you may think, or we a lot of times we think that, oh, cool, because all this stuff, naturally the housing market dropped,
Right.
especially with rents starting to not come in and stuff. It hasn't yet, as I'm sure Will can tell you. So with that being said, now will it eventually? Yeah, like days on market are gonna increase. There's gonna be like it's simple supply and demand, right? I'm not an economist by any stretch of the means, but at the same time, I just don't think it's perfect for right now. I think will you have some great opportunities in the future? 3 months, 6 months, a year from now? Absolutely. And what you should be doing is listen to these podcasts or whatever we call these things. Listen to plenty of other Bigger Pockets podcasts, read books. Will hit it on the head. Like talk to real estate agents now. Get your credit right. Start an LLC and start your business credit. Like get that right. So that way you can you can purchase something when the time does come and when it is a good deal. And then lastly is like build your relationships now. We talked about agents, but also call lenders and start finding out what you need to do to be pre-approved, especially during these times because they're all raising their expectations a little bit. So that would be my recommendation.
Yeah, how long would like that pre-approval process take for someone just starting out?
I don't know.
I think
I don't think it's long.
It generally depends on the lender and yourself. I found that it's kind of how reactive you are. So if the lender sends, and as well as the lender, if you find you have a lender that's dragging their feet, move on, find someone else. There's plenty of lenders out there that want your business. But if a lender sends you a list of documentation they want to pre-qualify you for a refinance, a commercial mortgage, a hard money mortgage loan, anything like that, you can get them all paperwork right away. They can do it pretty quickly. Within a couple of days, they can run it through their underwriting, maybe a week. Especially now, there's not a whole lot of first-time home buy. There's not a whole lot of buyers on the market right now. So, aside from the refinances that are happening, lenders generally should have some free time right now.
It depends on which type, what kind of lender, I guess, because there are tons of SBA loans going on, so most lenders are just tied up with them still. So I guess until they get fulfilled, and I think that's still going to take some time. So you might see it a little bit slower at first, but you can still start the process. There's people that are hungry. There's lenders that are hungry out there that want to build their network. There's other ones that don't care. So yeah, you gotta find the right lender.
And a lot of the times with these commercial refinances or commercial loans or hard money lenders, unlike a residential mortgage, they can keep your paperwork on file for the year. So, you provide them 2 years tax returns, bank statements, everything like that. They hold it on file. And then when you find a property, they just underwrite the property versus having to re-underwrite you as the applicant. It's different from the residential mortgage standpoint where every couple of months they need new everything, new pay stubs, new bank statements, everything, so it really depends on how you're planning on purchasing, like Neil said, and the type of lender you're going with. But yeah, it's really not a bad time to figure out if you're qualified, because that's the biggest part if you're looking to borrow to invest.
Pull
Right, so
back to what you were talking about, cash flow. We started trailing off a little bit, but you're talking location and where to buy, and you could look for these cash flow markets. Anything else on cash flow markets?
I think that pretty much covers it. I mean, the cash flow market, I think, is kind of self-explanatory. It's a cheaper market, high, you get solid rents. It's going to appeal to most investors. I think the other model of investing is the appreciation model we kind of touched on a little bit earlier on, but it's basically, especially in growing cities, growing areas, Philadelphia, Nashville, Houston, some of these cities you see that are just growing in population size. The school districts are getting stronger. Job opportunities are growing in those regions. You start to see house values jump up as opposed to trickle up like they do in your standard counties that are pretty well established already. So, if you're in a standard county and area, you see a couple % appreciation every year, every few years. In some of these areas in Philadelphia, you're seeing neighborhoods. I mean, to give an example, the Fishtown neighborhood of Philadelphia went from, a fairly lower class neighborhood to almost unaffordable in a 10-year span, maybe 15 years, due to, location obviously is huge. A lot of developers picked up on the neighborhood. And if you're an investor and you got into those neighborhoods, I have an investor client that purchased a 3-unit building in Fishtown in 2008, I believe. I think he purchased it for a little bit over $200,000. The property is worth more than $500,000 right now. And he really hasn't he did a couple updates to it, but just appreciation has gotten him to where it is. So the property, I would say, doubled in value in a 10-year span because he picked the right neighborhood. So, the appreciation model is really just doing your homework. Again, something you could be doing right now, targeting neighborhoods that have incoming large businesses, a lot of, walkability, location, things like that, and planting seeds. Find a few properties. You don't have to own the whole area. Find a few properties, and those properties might double in 10 years. I mean, what investment can you make that doubles in 10 years?
Yeah, so I'll give you some of my thoughts on appreciation. It's interesting. Like you talk about, I think there's 2 different types of appreciation. There's many types of appreciation, but I'm going to talk about 2 different types. Like, there's one that you're trying to catch the wave, right? And that's what Philly has been doing, right? There's been this wave of Fishtown and that area, the brewery town blew up, right? So everyone's trying to catch the wave. So, right, and what people do is they go a little bit outside that bubble, and they keep purchasing a little bit outside. All right, so if it's not brewery town, it's I'm blanking on the name now, but right out Grace Ferry or something, right?
Mm-hmm.
If it's not
Francisville.
Yeah, Francisville. If it's not, what else we got?
Point Breeze is Grace Ferry.
Yeah, that's the one.
West Philadelphia, Cobbs Creek. Those are all
you got 'em.
Kind of like
I don't know.
little towns, like sections that they were surrounding a really popular area. Like University City is a very popular, expensive part of the city. People started to move a little bit further west into West Philadelphia, into Cobbs Creek, and you started to see a significant amount of development. Now those homes are worth twice what they were, 10 years ago. And they're you can't find them at a good price anymore. There's so much competition. So, that's the downside. The downside is in areas like that where everyone's trying to find that wave and ride it, there's a higher price point. There's more competition. And, you're kind of bidding up properties because that's the way the market in that neighborhood's going. So, if you're going to try to be that type of investor, right now, understanding how to do it correctly, putting steps in place, learning your process is huge because you're going up against experienced investors in those neighborhoods.
Yeah.
There's
a couple things you could do also to, if that's what you decide. If you say no, I get it. There's like, that's where like people that have done that and did really well at it, got their stats down, their analytics down, and executed. I mean, they made tons of money doing it, especially in Philadelphia. So I get why you would. And just real quick, a couple things you could look at is you could pull like permits. You can pull how many permits are being pulled. So like new building permits. You can look that up on census.org. You can look it up. I'm pretty sure city data, city-data. So they'll tell you how many houses are being built. And obviously, if it's overwhelming, like you probably missed it. But you can start seeing when it gets further and further out, and you start seeing permits being built. Especially, you can see who they're pulled by, and you can see if these companies are like, are they ahead of the curve? Are these big companies, stuff like that? So that's a way you could check that out. I prefer, I mean, I would love to do that, but I'm not an expert there. So the other appreciation is you just look for long-term appreciation. It's kind of the same thing, Matt, you mentioned stocks earlier, kind of like Warren Buffett's approach, where you look for, you want something that is, appreciating over time. Like he looks for the steady appreciation, not the huge wins that are going to, in a year or 2 or 3 years are going to appreciate tremendously, but instead, you get the constant 2 or 3% appreciation. So that's especially in the suburbs, you get that a lot more than cities. So just be cognizant of that and choose which path you want to go.
Yeah, so I think that that kind of summarizes the appreciation method. You're looking for an area that's not gradually increasing in value, but there are significant jumps in value. And some of the ways to go about looking for that are, like Neil said, seeing where permits are being pulled. I don't have an agent run reports for you. These are all things that you can start doing now, so that when things loosen up, you can target those neighborhoods, and that's another great way to pick. That's another great model to go about if you're looking at geographically where you should be investing. Another model a lot of people use is kind of a little bit of both. It's more of a turnkey model. When we talk, a lot of the times we talk about the BRRRR method because we like that method. It's an easy method to fall in love with. You're leaving very little money in the deal. But there's a ton of investors that are turnkey investors. They're buying properties with 25% down at least, or sometimes maybe even 15% down if they have a great relationship with a lender. They're not putting any work into them. They're leaving the money in the deal. They're letting it cash flow. And over time, they're building equity and value by just letting the property take care of itself. It's kind of more similar to the stock market where you're putting money in and you're just letting it grow. That's what the turnkey method is. You're putting money into a deal. You're buying a stock or a business, which is that property, and you're leaving that money in there for a long period of time and letting it grow over time. And that could be great, if you have some extra cash that you don't need right away and you can afford to purchase a property. The positives are there's no work involved. It's literally a turnkey property. It's ready to go. You don't have to worry about a renovation. You don't have to find contractors. You don't have to do a scope of work. It takes all of that off the table. Makes life much easier. The downside is you're leaving money in the deal. You're tying up your cash in a deal for a long period of time before that property becomes very valuable or profitable to you. So what are your thoughts on that method, Neil? And then Matt, do you have any questions about that?
Yeah,
I got a quick question now.
Yeah, shoot.
So if I'm thinking about that model, right?
Sure.
BRRRR versus buy and hold or turnkey, what you call it, turnkey, right?
Yes, turnkey.
So if I'm thinking, all right, I'm just getting started. I'm trying to figure out which model I want to go with. Let's say I have like very little to invest. I'm like under 10K in just excess funds. And I'm like, well, where can I best use this money? Because putting it under my mattress isn't really going to help me all that much. So, or maybe it will when, the whole world dies in like 6 months or something. But, I think that when I'm, oh, sorry, yeah. But when I'm thinking about, trying to like decide which one I want to go with. Um, where would I like put my brain when thinking about how I'm getting a return on this money? Because obviously the burr is like a very clear, I put this money up front for a few months and then I get it almost all back if it's a perfect burr. So the risk there seems very minimal to someone who doesn't have a lot of just like holding capital sitting on a like a dragon on a hoard of money, just trying to make more of it. So when I think about the turnkey model, I guess that what I would do is try and think about, okay, how much cash flow am I getting per month versus the money I'm leaving in the deal, and when do I break even on that, and is that a worthwhile investment? Is that the right like thought process, or are there other things I'm not considering? Because that to me seems like Burr is a lot better as far as a return on investment than the opposite, the turnkey.
I agree with you. I think on the surface, the burr sounds awesome. And I'm going to be very real with this answer because it's an issue that I think people don't approach correctly. If you are looking to be a real estate investor, you need cash. You need a good amount of it. The zero down investing strategy, there's no such thing. If you're not using money in an investment deal, it means you're using someone else's money, which means you're paying for that money by paying interest on it. It's a loan. That's what zero down is. You know, these seminars that charge people tons of money to teach them how to invest with no money is just teaching them how to ask people for money. That's it. And I don't personally subscribe to that. I think if you are going to be a real estate investor, you need to be prepared because there are going to be mistakes. So someone comes to me and they say, hey, I have $10,000. I wouldn't recommend they get into a burr. I would say, listen, let's look at a different method. There are different methods. You can do a house hack where you use a standard FHA mortgage. You buy a 3-unit building. You live in one of the units. You get a full 6% seller's assist towards your closing costs. Maybe there's community grants. You might not have to bring anything to the closing table. And you have a 3-unit building that you're living in one of the units and it's cash flowing. That's one method of investing. You can do the same thing with a single family home. Buy a single family home, rent out 3 of the bedrooms, live in one of the bedrooms. Airbnb, you know, that's not great right now, but and just in a general market, like that might be the way to go. Or you can go the route of using that money to market. If you want to market, like Neil's doing a little bit of this, where he's marketing directly to home sellers to see if he can possibly wholesale these properties. That's another way of investing that money, not just in the let me find a deal and flip it. No, there's different ways to use your money, but if you're working with a minimal amount of cash, going the FHA route, the house hacking route, that would be the way I would recommend versus trying to pull off a deal with a minimal amount of money because you're going to end up in trouble. Things always come up in transactions. They always do. No matter how correct you do a flip, there will be mistakes. And when that mistake comes up, if all you had was just enough to buy the deal and your holding costs, that's where you run into trouble. And when I'm talking to first-time investors, my goal is to keep them out of trouble as much as possible. So
We want to avoid risk.
Correct. And I mean, you're taking a huge risk buying a property and investing in it. So if you don't have the reserves or the capital to float this thing through the end when problems happen, because they will happen, then your life's going to become pretty terrible. And it's happened to me. I'm speaking from experience. It's happened to a lot of people I know that tried to rush it and didn't do it right. And I think if you don't have enough cash and you don't want to go the house hack or the FHA route or maybe becoming a wholesaler, then save up more. Time, might be your best option, just waiting a bit. So I don't know, Neil, do you want to add anything to that?
Yeah. All good points, really good points. I'll first off say that I personally do not currently invest in turnkey properties. That doesn't mean that I would never. I just find that by burring, you can do more with your money. And that's my approach. Like, I have a target to hit 16 units this year. Like with that, to be able to do that, 16 houses or whatever that factors into, 8 houses, 16 houses, 4 houses, whatever, depend on the units. I would need a whole boatload of money up front, whereas Burr gives you the opportunity to put down some money. It doesn't mean I don't have money, right? And that is true. Like Will was talking about, you got to have enough money to be able to float this stuff. And honestly, a good lender will make sure you do. They won't lend to you without, but that doesn't mean all of them are that way. But a good lender will generally check that stuff and like tell you no if they don't think you can make it, or if something were to come up. So anyways, me personally, I like to think that I'll take that same chunk of money that I would throw into one property, and I can maybe get 3 properties out of it after refinance and get my money back and all that stuff. So that's my particular reason why I enjoy Burr investing. However, as an investor, I think it's really critical to know as many different investment strategies as possible, and to know, like, it doesn't mean Burr is the best strategy at all times. It's not. In fact, right now, a lot of Burr investors could get themselves in a lot of trouble. And we talked about this last call as well. If they're not conservative with numbers, if they don't have reserves, all that stuff, like they could get in a lot of trouble because you may be over leveraged by doing Burr method. Which the great news about turnkey is you're not going to be, unless you buy it like incredibly wrong, at the top of the market. You're not going to be over leveraged at all. Because you're going to throw up 20% or whatever it is up front, you automatically have a cushion there. And then generally you can get some better cash flow right off the bat too. So, there's definitely positives to turnkey. And then just like Will said, you don't have to do anything. So the great news is you don't have downtime like you do with a Burr.
That's a good point.
Generally a couple months of downtime. You're not collecting rent. You're only paying, you're paying payments, So especially in a market like this, that could be, not so great. So,
but even Neil, even in the worst of times, like in 2008, when everything crashed and it was an actual real estate crisis, the worst markets got hit about 15%, right? So if you're a turnkey investor and you're putting 25% down, you still have equity.
Good call.
And that's big. I mean, even if you had to bail out of that transaction, you still have enough equity to sell it and not take a hit. If you took care of the property, and you kept up on your maintenance, in a time like, and since then, those values have grown back. So if you held tight and your property lost 15% value as a turnkey investment, the property values have gone up significantly since 2008. So you've made your money back and made a profit in equity over that time period. So real estate is a strong investment. It comes back even from the worst times. So turnkey isn't a bad idea. And turnkey could be as simple as using an FHA loan and buying a property up to 4 units in the residential space and living in one of the units. I mean, you could do that with almost no money down. So it's not impossible to get into real estate with very little money, but like Neil made a great point, just know the options available to you. There's a ton of different types of real estate investing. And if you don't know, speak to someone that does. Call an agent that's familiar with real estate investing, call an investor, go to meetups like Neil does. Knowledge is power when it comes to real estate investing. If you could find a way to get a deal done creatively, and the only way to do that is by understanding all of the possible ways to get a deal done, then you need to keep learning. I mean, up your education right now on investing.
Real quick, can I touch on something that Matt said?
Sure.
You were talking about how you analyze like which way is better. There's a great metric and statistic that you should know how to calculate, and that's cash on cash return. That's critical, and that's to me how it's not the only factor, but it is a big factor that plays into if I'm gonna Burr something or go turnkey or something else, right? And that will tell you, it's pretty easy. Basically, you take your total annual rent. So I think you talked about your monthly rent, add that up, times it by 12, your total annual income, and then you divide that up by your total investment. So depending on how much you spent on the house, that will tell you your cash on cash return. Why that's important is it tells you, it's an easy way you can compare your investment with other investments. Meaning if the S&P 500 will get you, I don't know what it gets you right now. I have zero money in stocks currently, besides my Best Buy stocks that I'm giving every year. But let's say that's like, I would imagine over the last couple of years, it's probably been closer to 8 to 10%, my guess. Maybe even a little bit more, because obviously it's been a hot market for years now. So then you want to make sure that if you're going to invest your money in real estate, you got to get over a 10% cash on cash return, or else why not put it in an easy fund, right? So that's why that's important to me. I'm sure we'll talk about that later when we start analyzing some deals, but.
Yep.
Yeah.
And then, in terms of, some of the other models, I think the two big other things people need to consider are if you're going to invest locally or you're going to invest in areas outside of your general reach. Locally meaning you can drive to it on a regular day. It doesn't, take away from your full-time job if investing isn't your full-time job. It doesn't take away from family time. You could stop by there a couple times a week, check in on your contractors if that's happening. If it's already a rented property and, there's an issue with a tenant, you could swing by there and check it out before getting a plumber or an electrician out there to save some money. It really, like, a lot of people, my personal feeling is if you're a new investor and you're not a turnkey investor or has a lot of cash, I want to see a full deal through from beginning to end. And I want to be able to be on site to understand all the processes, learn all the processes, be able to stop in frequently and see how the project is progressing. I want it to be local. That's my opinion. Now, there are very successful real estate investors that invest in areas completely outside of where they live. And I think those people have just built a really good team a couple times and they know how to do it. And they can replicate that process in a new market fairly easily because they've done it before. So, my opinion is if you're a new investor, I would start locally before I started reaching to other areas. What are your thoughts on that, guys?
Yeah, I agree
certainly
100%.
made my first one really easy. That's for sure. I wouldn't even know where to begin on how to do something that was, halfway across the state. Like, how do I check in on progress? How do I make sure that things are going smoothly? How do I even know what areas are up and coming or have already blown up? I would just be kind of like at the mercy of numbers. And, numbers are great to rely on, but I think having the confidence the self-confidence that the area is a big motivator for actually going for something. Like, if I know that the town next to me has always been a place I wanted to live, and I found a really cheap home there that I could fix up and get like a really big forced equity boost through the Burr method, I would feel a lot more confident in myself having seen that through knowing the kind of the backgrounds of those areas. Because just going for it and saying, okay, let's put in this offer is such a huge step for a first time investor. And doing that, out in like Lancaster or somewhere in the middle of PA where I have no relevance or understanding of where to put my feet out there, I would be very scared. So for first time investing, I personally felt the self-confidence to be able to be like, I know that area, I know exactly how that is going to turn out because I have an intimate relationship with that part of that that town, or that town's really close to a town that I love or I grew up loving. So that helped me for sure.
Yeah, I'll tell you, I agree 100% personally. Like I think you should invest locally. And the reason why, we talked, find the right location. There's plenty of stats, as Matt just talked about. Like you could pull up, tons of different stats and websites and find where population growth is, where unemployment's the lowest, and in fact, job growth is the highest. And price to rent ratio. You can pull up all this stuff, right? Which is important, and I do suggest at some point do it. However, imperfect action to me beats perfect inaction every single time. What I mean by that is jump in, like just jump in. Like if you, especially locally, you'll know these areas better than the other areas, the middle of Pennsylvania. So what's the worst that can happen? Like you're going to learn along the way, and it's okay to adjust later on and say, you know what, that strategy was probably wrong. I probably shouldn't have jumped in and bought a house there. But guess what? Like, like I didn't do really any research on on first property, and it's really, it's not a place that I want to be. It's not a market that I believe there's any appreciation at all whatsoever. It cash flows for now. It works for now. It's when all said and done, it's not the end of the world. I learned a tremendous amount. I can get rid of that property pretty easily, and we were able to go in there and raise rents and make it a nicer place in the neighborhood. So it is what it is. So what I suggest is doing something is better than sitting there. Just make sure you're like, there's so many people that have analysis paralysis. You've heard, I'm sure, that will run the calculators all day long, but they'll never do anything. So to me, like that's the most important thing, is to to jump in, like get your knowledge base down. It helps having a plan, of course, hence why we're going through these steps, but just take some action.
Awesome. Yeah, I totally agree. There are benefits to investing outside of your area. Philadelphia is a very difficult market to get really great rental returns. The greater Philadelphia region, the counties we live in, with the property taxes, it's hard to make money with the expenses or the cost of living in these areas. So, the regions like Atlanta, the Bible Belt region of the country, where you can abide by the 1% rule, and that a lot of investors do. We can't do that here.
No.
In the hottest parts of the city, investors are happy to get a 4.5% cap rate. Like that's insane,
Crazy.
Insanely low. Where you should be kind of going on market averages between 8 and 10%, or hopefully better in some of the cash flow regions. It's hard to be a cash flow profitable investor in some of these regions. So I get why people reach outside. I've just seen that the people that do it successfully have experience building a team, and have a team around them that runs analytics, understands what they're looking for, and can implement that in any market. If you're a new investor, that's a daunting task. I think your best bet is to start locally, start with something you're familiar with. It takes a lot of anxiety off your plate, and it gets you kind of to jump in, like Neil said, get your feet wet, go and do this. I have this conversation with a lot of people every day calling me, they want to be investors, and usually a couple questions and I can tell that person's actually going to do this or not, and I think if you are a new investor, you have to jump in. There's no amount of preparation is too much preparation, but at a certain point, if you've just seen time go by and you haven't pulled the trigger yet, just do it.
Yeah, I'll also say, sorry, you probably heard my son yelling. He's running around thinking he's a dinosaur or something. Anyways, yeah, so there's you can definitely invest out of state or whatever. I just personally don't think, like, I would start locally. But if you feel, like Will said, if you feel comfortable building a team around you, obviously I would highly suggest you got to visit the area. Also, just a quick plug. There's the latest Bigger Pockets podcast, 379, episode 379, is heavily about the data and analytics and specifically it dives into areas. It's called BP Insights. I guess they just launched it recently, and I was checking it out. It's pretty cool. So they have a list of like all the best cash flow in areas, and not just best cash flow, because that really doesn't tell you everything, right? But also like price to rent ratio, taking out vacancies, which is really, really critical for that too. So they give you a lot of data. If you do want to venture into that, check that out. If not, because you can win in any single market. So my suggestion is, if you're starting out, stay local, but if you really want to venture, go ahead.
Awesome. All right. Well, I mean, that kind of covers all the different models, investing in your area, outside of your area, turnkey, appreciation markets, cash flow model. So Matt, kind of, we discussed putting yourself in the position you are, which is a new investor. You have any questions come off the top of your head that you think would be worthwhile us giving our best answers to for some of our clients?
I often think about cash flow as my number one, and like we keep talking about cash flow, but like as Neil said, cash flow is not the entire picture, and I often get confused and kind of wonder about equity growth versus cash flow. And I feel like the equity that you have in a piece of property is this kind of like ethereal number that is, your target when you're trying to do these projects, but it's not in the forefront of my mind. And I don't know if that's a detriment to me just being a new investor, but there are basically two areas to win, right? And the cash flow is your business's profitability, I guess you would say. But then you have like your company's worth, or there's a word for that when you're determining the value of your company or whatever. I don't know, but valuation. Yeah. So like that's the other end. And I think that when I'm trying to figure out what to do with the approach, it seems to me like obviously the cash flow model is talking about cash flow, but the appreciation model is talking about equity. So I always get kind of confused about what equity is and where it comes from and how it's built through real estate investing. And I was wondering if you guys could just push on what exactly equity is, where it comes from, and how I can kind of lean on that as a way of or as a return on my investment, because I'm pushing up the value of my home, right? But I don't know where that's going to go unless I have like all of the numbers. And so you kind of just are hoping that it appreciates backed by what's been happening in the past. And it's kind of like a wishy-washy number. So I don't know, maybe you can explain that a little bit more.
I'll start on that. I think the number one factor when it comes to the equity in your home, the equity in your home is what that property is really worth to you. You can have a $1 million property that's worth $1 million and you owe $1 million on it. Well, that property is worth nothing to you, right?
Yeah.
It's worth $1 million to the bank. So if you own a property for $1 million and you have a mortgage of $750,000 on it, then you have $250,000 in equity. That's the portion of that property you own. So that's why it's the most important part of that property. To me, the equity in a property is most important when you are looking at the appreciation model, right? If you're thinking about cash flow, you don't really care too much about the equity in the property. But if you're thinking about appreciating market, you need to know how much equity is in the property. You need to know because you're not really getting a ton of cash flow. In these appreciating markets, you're probably making $100, $200 a month per door after everything's said and done. And for a lot of people, that's not enough money. But if the property is going to continue to appreciate in value, you have to think, well, hey, I'm $200,000, $300,000 into this property. In 5 years, it might be worth $400,000. I've gained $100,000 in equity that's the portion of that property I currently own. So that's one thing to think about. The other reason that's super important, especially when you're doing the BRRRR method, is because if you're trying to leave as little money as possible in the deal, you have to know that the bank that's going to be doing the loan on the back end, it's going to refinance the property after it's renovated, usually isn't going to lend you more than 75% of the new property's value after it's completed the renovation, the ARV, the after repair value. So when you're evaluating a deal, running comparable sales, making sure you know what that home is going to be worth when the renovations are completed is extremely important, because those are the numbers an appraiser is going to use to tell you what your new value on the property is. And that is your ARV. If you owe any more than 75% of that ARV after the entire transaction is completed, you're leaving more cash in the deal. And that's where your cash on cash comes in. The more cash you leave in the deal, how much is it worth to you? So if you can do a BRRRR and leave no money in the deal, be 75% into the entire transaction, after the renovations are done, after your holding costs, after everything, that's a perfect BRRRR. And if you can be 65% into it, then you just made money, right? If you're 85% into it, then you're leaving 10% in the deal. And that's where it's important. How much money are you willing to leave in this deal, right? So
Gotcha.
the equity is, yes, it's part of your property's evaluation. It's understanding, or evaluations, it's understanding what your actual your company is worth. But it's also important in when you're evaluating a deal, how much do you want to leave in a deal? And if people go back to the first episode, we kind of went through our recent BRRRR, and we left a little bit of money in that deal, but it was worth it to us because it made sense. The cash for cash return made sense. So I'll let you go from there, Neil. I don't know if I missed anything or you have any other thoughts.
No, I think you nailed it. Yeah, I'll just tell you from the other side, the cash flow model. I mean, you still are more than likely gained equity. Obviously, it does fluctuate based on the valuation of the property, based on what's going on in the market, right? But yeah, you're still in it to gain equity, right? There's principal pay down, so that's the biggest way you're going to get equity. First off, you're going to force equity. Number one is through rehabbing this this property that was more than likely distressed. That's what I look to do. That's my strategy. A distressed property, I rehab it, I make it worth more money, and then I only paid a certain amount, so I automatically get a good bump. So if, let's say, they refinance me at 65%, I'm all in for that. Cool. Well, I know I have 35% equity already, right? That's pretty amazing. So that, for one. Number two is there's a calculation to help you with that. It's called IRR, your internal rate of return. And that's something that will help you figure that what your equity is going to be over time. So we won't dive deep into that. It definitely takes too long to calculate, but we'll hit that later on when we're analyzing some deals.
Yeah, it seems like we're going to need a whole episode on all of these different calculations that you can do to make sure you test this up. Yeah. Yeah, that's good.
Any other questions, Matt?
I guess one thing you talked about was cap rate, and I don't know if we want to get into that today, what cap rate is and how to. It's another calculation, but that always confused me. It seems like a big scary thing that people talk about and always use as a place to compare yourself to make sure that your investment is strong. But I always get confused on what that actually is. And I don't know if you want to just run through that real quick. You also said the 1% rule, and I think it's probably important to touch on that, what that is too.
Okay, I'll touch on the 1% rule.
Yeah.
Neil can do the cap rate, but the 1% rule is just kind of an easy calculation to see if a property is worth doing. It generally, investors look for if they can get 1% of the property's value be the rent. So if you have a property that you're $100,000 into, or it's worth $100,000, you can get $1,000 in rent per month. Generally, it's going to be a profitable property. It's an easy way to take a look at a property and say that's going to work.
Gotcha.
A $250,000 property, if you can get $2,500 per month, it's probably going to be a profitable property. So that number tends to not scale as you get in the higher end, and it definitely generally doesn't work in our area, but in a lot of markets it does.
Yeah, so as far as cap rate, I'll try to simplify this as much as possible, and hold off, till the I guess when we go over our analysis. But cap rate's an easy way that you can kind of you kind of compare properties, and it's really more for commercial properties, 5 or more units. It doesn't make that much sense to look at under 4 units. You'll see people will put cap rates on there. Some agents will throw cap rates on there for like a duplex. It's almost pointless to look at that. And in fact, it's a lot of people think that cap rate's like the end all be all, and it's far from. So it's a good like quick gauge or measurement whether I should look in more, but it's not the end all be all. So just basically what it does is it tells you, it stands for capitalization rate, and it tells you how much, or the calculation is how much in net operating income for the year divided by your purchase price, right? So let's say it's $100,000 property that we purchase, and it makes $4,000 a year after everything, your net operating income, your take home, right? After every single expense, that would be a 4% cap rate, which that's what Will just talked about. Like some investors, especially in Philadelphia with bigger projects, bigger properties, like I see it all the time, that they're willing to take 4, 5, 6% cap rates, which to me boggles my mind. Like that's insane. I want something that's above market rate, above market cap. That's how you can get a better deal out of it. But anyway, so yeah, just generally a low cap rate implies lower risk, and a high cap rate implies some higher risk. But to me, if I'm purchasing, I want to purchase a high cap rate, because that means that it's generating a lot of NOI already, versus my purchase price. It's kind of similar to, like, in that aspect, similar, not same as that cash on cash return a little bit,
When you say you're pushing to try and be above market rate or market cap, what do you mean by that?
Yeah, so the average of the market. Each market will be different. So, like, for instance, Philadelphia cap rate right now, I don't know what it is. We would probably have to talk to a broker there. But my guess is the average Philadelphia cap rate on commercial properties is probably something in the range of like 7% or less, maybe 6%. It's low. So I want to make sure I purchase over that, and that means I'm getting a value. So that's my spread. So if you purchase under that, which it's okay to do, it's more that like turnkey versus, like it's okay to do it. You just don't get as much value or force equity out of it.
Yeah, to answer a couple of the questions Neil brought up as well, Matt, I think number one, if you're a turnkey investor, a doctor, a lawyer, someone that has a lot of cash on hand and you don't have a lot of time, if your money's in the stock market and the stock market is dumping or tanking with the economy, you're thinking, why wouldn't I just put this money into real estate and get a 4.5% solid return on it, right? So that's, you're speaking to that type of investor when you're looking at these lower end cap rates. And a lot of these times, these investors are parts of funds. They're parts of these massive funds that are, have syndicated, and they have hundreds of millions of dollars, and they're getting a quarterly check. They don't know what their return is monthly. Well, they know what their return is, but they don't know all the parts that go into getting to that return, right? So that's where you see the market get driven down by those types of investors, and that's okay. That's for that fits their mold. When you're talking about a duplex, a single family home, a triplex, even a quadplex, you don't really need a cap rate like Neil said, because there are generally comparable sales that banks can use to come up with a value for that property. Once you start getting over 3-4 units, you're into 5 units. Now you're in commercial real estate. Once you go over 4 units, it's considered a commercial property, even if it's only residential rentals. There's not, if you're a bank and you're trying to figure out how much this property is worth, there's not going to be 5-unit buildings that have sold in the last 12 months in that township or school district. There's not. They're very uncommon. So you have to find a different way to evaluate the property, figure out the value of the property. And that's where you see banks using cap rates and investors using cap rates to figure out, okay, if I can buy this property for $400,000, the cap rate is 6.5%. But if I can buy it at $300,000, it's 8%. And then I can go to a bank after I finish my raising my rents and come up with a higher evaluation. It's a larger style burr in that sense. So cap rates get more important the bigger the property, the more units. If you're a first-time investor, it's really not that important to you. The bigger number is just how much am I taking home every month after everything, and how much am I leaving in the deal. But yeah, we'll definitely do a full episode on cap rates.
Awesome. So like let's say I'm all right. So I'm ready to start investing. I went out and I got my financials in order. I got either pre-approved or I got a lender who I'm comfortable with. What are my next steps to lead me to getting ready to start evaluating deals, if there are any, or am I there?
Yeah, I'll take this one if I may.
Mm-hmm.
So you do a couple things. First off, you figure out how to evaluate a deal yourself, which we'll go into probably one of the next episodes.
Yeah, that'll probably be next.
Right. So you figure out how to evaluate deals. Just, you can simply go on BiggerPockets. They have free webinars that are incredible to start off. And again, I hit on this last time, is just pull up Redfin or Realtor or whatever, Zillow, and run through some evaluations. Yes, they're not going to be perfect. Yes, you're guessing on construction and stuff like that, but just run through it, and that way you get some of the numbers like cash flow and cash on cash return. So that for one. And number two is you call Will and you say, hey man, I got all my financials ready. Here's what I'm thinking. And he's a professional. He's really good at this stuff. He's going to help you make sure it's a good idea, right? He doesn't want to put you in a bad spot. And he's also going to help start to set up some criteria for searches, right? And that way, and Will does a great job that he looks for opportunities as well. So he'll keep you in mind and say, hey, this looks like the kind of properties that Matt's looking for. Let me shoot it over to him. So.
Awesome.
Yeah, I think that's pretty much it. You can do as much research as you want online, but a lot of times the easiest thing sometimes is just to call a professional, and it's like when we have questions about accounting, we call our accountant,
Yeah.
We can spend days trying to figure out the answer, or we can just call her and say, hey, what is the answer to this? And usually she has it right off the top of her head. That's her profession. You don't have to reinvent the wheel. You can make life much easier for yourself by just tapping into current professionals. And if agents are active and they're worth their money, they'll take the time to explain the market to you and give you as much information as they can about a specific market. And if they don't know, they can do some research. It's not that hard for us as agents to find that information. And like Neil, you're not an agent. You were able to find a lot of this information online yourself as well through, there's tons of websites, Redfin, all these sites put out information for people that don't have access to the MLS to tap into.
Yep. Yeah, and that's all part of your team. Like you gotta, this is a great time to build your core team. You need a realtor. You need someone to help find deals and funnel deals for you. Now's a great time if you don't have one, to call them, make that connection, and especially now they'll have a little bit more time for you to start developing on that relationship and vetting out what you're looking to do. So that's really critical.
Yeah, awesome.
Cool. I guess that'll lead us to the next video.
Yeah. So
evaluating deals.
Nope.
So our next video for this series is going to be evaluating deals.
Yep.
Okay, awesome. Thank you for everyone for tuning in. Please share this with everyone you can. We'd love to grow the viewership of this, and hopefully it'll lead to more guests and us being able to provide you with more information. If you're an investor or trying to become an investor, feel free to reach out to Neil or myself. If you have a deal like the situation Matt put out earlier, where you don't have a lot of money, but maybe you found a deal, reach out to Neil or myself. Maybe we're in the market, or we know someone that's in the market and we're looking to do our next deal. We can help you. We can find a way for you to make some sort of earnings off of selling the property. There's different ways to be a real estate investor. It doesn't have to all be burrs, rentals, flips. There's plenty of ways to go about doing this. My name is William Holder. You can reach me at williamholderrealty@gmail.com or 484-744-4053. I'll let Neil and Matt share their information, and then we'll wrap it up.
Yep. Neil Henning, you can find me at highviewhomes1, the number 1, @gmail.com, or my phone number is 610-212-0256.
Yeah, and if you send any email to admin@William Holder Realty, that'll go directly to me. So that's where you can find me, Matt Porter, doing all the operations management for Will.
Awesome. Awesome, guys. This was great. I'm looking forward to doing the next one and getting this information out to everyone as possible.
Sounds good.
Awesome.
Well, thanks,
Good seeing you guys.